Hello, everyone, and welcome to episode 3 of the Compound Indian Investor. In this episode, we're going to do something a little bit different. I'm going to go over my top 5 picks for the coming financial year. It's going to be a two-part episode. So, this is going to be part one, where I'm going to be covering 3 of those picks. And in the next episode, which will come out on Wednesday, I'll be covering the remaining two. But as always, we're first going to start with a portfolio check. So the markets moved up quite a bit. It's been a good start to the new financial year. Within the first week, we saw a lot of recovery in the mid cap sector. We saw the general Nifty, Sensex, etc. also move up slightly. Because of that, our portfolio has also done better. We've moved up to 6.39 crores. As you can see, this is the yearly. This chart shows the 1 year. Week on week, we've gone up 3.73%, which is a massive gain for 1 week. Monthly, we're up 3.06%. So you can see we are actually up less on a monthly versus on a week on week. So the markets had corrected a bit in between and now they've recovered, right? So that's why you see, and the reason I want to put this information out there so that we can also monitor the fact that there's going to constantly be some sort of up and down in this market. It's not always going to be a smooth ride, not a straight ride, right? There's always going to be up and downs. But the important thing is that in the long run, we're growing the portfolio. And you can see that with the year on year, 60% gains. It's not going to keep happening. It's been an amazing year on year for the market in terms of the mid cap performance. A lot of large cap stocks have also done very well, but especially mid and small caps, absolute crazy performance, right? 60%, that's what our portfolio is up. Can't expect this going forwards. We have to keep that in mind, but when it does happen, we have to appreciate it. So let's start now, okay, with our top 5 picks for the year FY25. So my first pick is a large cap stock, an absolute darling of the market, but has been slightly out of favor recently, and that's Asian Paints. I've been recently accumulating the stock. It's not usually the kind of pick that I like to make. I prefer the small and mid caps, but we just spoke about the massive run up that the small and mid caps have seen, which is why I feel that large caps in general will slightly outperform in the coming year. And within the large cap sector, you really want to look at stocks that are still growing, that still show good growth in terms of revenue, in terms of profitability. You want to look at market leaders. And for me, Asian Paints perfectly encapsulates all of that, right? I've highlighted the various points and I'll be going more in depth into each and every one of those points now, but I'll just cover them right now, right? So it's available below its 5 year and slightly below its 10-year historic PE ratios. It's a historical compounding machine. It just keeps growing earnings year after year. Somehow or the other, it just keeps growing your earnings. The reason why we've seen a correction in the stock of late is because Grasim is entering the paint sector, right? Aditya Birla Group, Grasim Company, they're launching a new paints business. So there's going to be increased competition within the industry. And this is leading to a lot of fears from a lot of people that margins are going to see a massive correction going forwards, right? I think some of those fears are overblown, and I'm going to expand on why. Asian Paints no longer only makes paints. They've expanded into the home decor business where, they do things like bathrooms, lighting, and other types of furniture. I'm going to speak a little bit about the expansion plans there. I'm also going to cover one of the risks, which is the crude oil risk. With the current Ukraine-Russia war, Ukraine is targeting a lot of Russian refineries, and that in turn is leading to crude oil going up, and that might be a risk which might see this pick underperform, right? In the coming year at least. I still think in terms of a long-term pick, this is a good one. So now let's get started. So the first thing that I want to cover is the historic PE trend of the stock, right? So this is an important mental model. It's an important concept for us to keep in mind when we're looking at investments. This was a sort of a strategy that Peter Lynch used to use. Peter Lynch, for me, is one of the greatest investors of all time. He was averaging something like a 30% CAGR return in the 12 to 13 years that he was working at Fidelity. Absolutely ridiculous returns over an extended period of time. And in his book, One Up on Wall Street, he covered this idea of looking at the historic PE valuations. You take your trailing 12-month valuations over time, you find out the average valuations, and then whenever the stock tends to fall below that valuation, you try to nibble in and invest, because that means versus its historic averages, the stock is probably trading a little bit cheap. And I think that's the case right now over here with Asian Paints. So we are looking at this from Screener, and as you can, so it's become very easy that Screener does this for us, but you can just see the earnings growth of Asian Paints in the last 10 years. Those blue columns over there, that's the how the earnings has grown. I mean, just what a fantastic company this is. Any company that can grow earnings like this, it's mind-boggling that, and I mean, it trades at a high P as it should, because it's a fantastic company, right? But today the PE ratio is dropping below 50, which compared to its 10-year average of 60 is definitely at a slight discount. Compared to its 5-year average, it's at an even more significant discount. I think the 5-year average is closer to like an 80. So there's potential over here, right? So that's why I've decided to look at the stock now. And I'm just going to go a little bit more into depth about what sort of a historical compounding machine Asian Paints has been, right? We've seen the compounding sales growth 10 years. You look at that, right? You have 10 years, 5 years, 3 years, growing, growing, growing. Profitability 14%, 15%, 15%, and now 43%, because it's coming off a low base. The way this stock has grown, and the interesting thing here is how the stock price has grown along with that, right? It's not massively outperformed over here. You've seen a 14% growth in profits and an 18% growth in stock price. 15% growth in profits in the last 5 years, 14% in stock price. And here's where the divergence happens, right? Profits have continued to grow for the company. They've grown fantastically, but stock price hasn't. And that's where opportunities come in. That's what I feel, at least. So let's talk about the grass inventory. Aditya Birla Group, about a year ago, they announced that they're going to be entering the paint segment. And there was a huge panic, within the industry that somehow Aditya Birla Group is going to come in, Grasim is going to come in and absolutely destroy the competition, right? So let's discuss this a little bit more in detail over here. What is the current Indian paints market, right? Currently, it's at around just under a 10 billion USD market, so around 80,000 crores market size. By 2029, it's expected to go to a 15 billion USD billion market. So it's the market itself is growing at almost a 10% CAGR. That's a pretty fast growing industry. By FY28, so we can see the market is going to be about, 1 lakh 20 to 1 lakh 30,000 crores. Okay. From that market, by FY28, Grasim is targeting a 10,000 crores. So they're looking at less than a 10% market share in the next 3 to 4 years. Currently, Asian Paints has close to a 60% market share in decorative paints and 40% of the total market. So when we're talking about this entry by Grasim And we're talking about them trying to take away 10% market share. Out of that, how much do we think is actually going to come from Asian Paints? Right? This is a company that over the last 30 years, practically, it has managed to withstand numerous competitors entering into the industry, and it has maintained and over the years, in fact, grown its market share. And this market leader status that Asian Paints has, I feel people really underestimate it. And Grasim as a company, Aditya Birla Group as a company, it's not, it's not that fantastic. I know some people will, might think that's a bit harsh to talk about one of the largest conglomerate groups and family owned businesses groups in India as not that great, but I genuinely don't think that great, and they already have this a massive amount of debt, 100,000 crores of debt. They've had to do a rights issue to sort of get the funds to help them enter into the paints market. I just I just don't see the optimism. I understand they had a launch show which was very impressive. I understand they're going to be looking to price cut the competition as they enter into the market. I think Asian Paints is going to be able to fight it. And I think the people who need to be more worried, we'll see that now in the next, in this slide, right? I think the people who are going to have to be more worried are going to be your number two, number three, and number four people, right? I don't think Asian Paints needs to be worried. So you look at the decorative, you see Asian Paints, 60% market share. Berger has 18, Kansai Nerolac is at 15, and Akzo Nobel is at 7%, right? So let's talk about now the capacities that are going to happen, right? So Grasim here is entering with 10,000 crores. When Grasim announced its entry with 10,000 crores, Asian Paints came out and said, okay, boss, no problem. We are going to invest our own 8,000 crores. All the other companies put together are investing another 2,000 crores, right? All of these fellows together will invest, all of these fellows together, they'll invest 2,000 crores. Asian Paints alone is going to be investing 8,000 crores. So you tell me, boss, Asian Paints alone already is willing to step up to that challenge. This is the current capacity, which is this 1,730 million liters, right? Post expansion, this is going to go up to 2,636 million liters. Grasim's entire new capacity is going to be approximately half of what Asian Paints' expanded capacity is going to be. Now, don't get me wrong, the entry by Grasim is very impressive in terms of capacity, right? It's going to make them immediately the second biggest player. This is Burgess. This is going to be Burgess' capacity post their capex, right? So they are currently Burgess also doubling capacity. They're currently at 620. They're going to be moving up to 1100. So Burgess also practically doubling capacity, and but Grasim with their entry straight away over the next 3 years, they're going to probably become the second biggest player in terms of capacity. They're not targeting to be the second biggest in market share yet, but in terms of capacity, they're going to be the second biggest player, tied second biggest, I should say, with Berger. None of that is going to affect Asian Paints. So, but if I was a shareholder of Berger or Kansai Nerolac, they both trade on the markets. I don't think Akzo Nobel does. But if I was a shareholder of these two companies, yeah, I'd be a little bit worried because I think that's who Grasim is targeting. I don't think Grasim is entering into this market thinking, yes, I'm going to take away much market share or any market share from Asian Paints. I think their targets are going to be the number two, three, four players, right? And other people have tried. Pidilite has tried to enter into this market. They've not done well. We've seen other big companies, big conglomerates try to enter into this business. It's not an easy business. It's a mature industry. Yeah, there's decent margins, yes, but those margins have been eked out by absolute top quality companies. There's no room for poor performance in this industry, and the quality that already exists, it's going to be difficult for Grasim to beat that quality. So I personally think that The fears from Grasim entering into this industry have been overblown, have been exaggerated, and that's why the price correction currently in Asian paints offers a buying opportunity. Let's also talk then about the home decor business now of Asian paints, right? So currently, this business is contributing 4%, and by FY26, so literally within 2 years, they want to double its contribution, or slightly more than double its contribution, right? Now, the nascent business itself is growing at around 15%. So, for the home decor business to double its contribution, it would have to grow at close to 30%. So, that's the kind of anticipated growth from this segment right now. It's not doing that well right now. If you look at the, it's EBITDA break even, not really EBITDA positive right now, most of its segments, but already Asian Paints is establishing itself as a market leader. It's already number one in decorative lighting. It's the number one integrated player, number two in fabrics and furnishing, number one in wall covering and textures. They started doing collaborations with Sabyasachi, Jaipur Rugs, Sarita Handa. So they know and they have the distribution network, and they know this market, they know the play. And this, I personally feel, will be the major leg of growth, maybe not in the next 2 to 3 years. I don't think PAT growth or EBITDA growth is going to come so much from this segment, but I think this segment could be the major growth leg for Asian paints in the next decade, because as this contribution slowly ekes up, you're going to see it become bigger and bigger portion. And here especially, I personally feel there's a lot less competition of this scale and capability and size, right, of what Asian paints is going to be bringing into this market. And for some of you who might who are invested in ITC. I was invested in ITC. I still am invested in ITC, but I had entered ITC at around 200 levels, and I see many parallels between what ITC was doing then with its FMCG business, and it had its nascent cigarettes business, and what Asian Paints is going to be doing with its home decor business, right? Where everybody was underestimating ITC's ability in the FMCG sector, and it was having a low valuation compared to other FMCG players because of the cigarettes business. And now you see how ITC as a stock has performed over the last 2 to 3 years, and how the FMCG business of it has outperformed, right? And I think the same thing is might happen with the home decor opportunity here for Asian Paints. It might not work, but the nascent business itself is so strong, and the management team, the professionalism, everything in Asian Paints is just so strong that you have to give them the benefit of the doubt, I feel. So this could be a potential additional upside, I feel. Anyways, I feel there's enough upside in terms of margin of safety, in terms of valuation comfort with its nascent business, with the cash cow business that it anyways has in paints. But I feel like the home decor business could add that extra 4-5% of PAT upside over a 3 to 5 year period. I may not necessarily hold on to the stock for that time period. My aim with Asian Paints is more, I feel it's at a historically low valuation. I think it's a good time to enter into a very, very good, strong company. And I think a 1 to 2 year period of holding, maybe as the price approaches 3,700 to 4,000, I'm probably going to look at exiting. But I think there's scope here, huge scope in the business there. At the same time, we've been talking about the bull case. Always good to touch upon the bear case of certain stocks to understand where things might go wrong. So I think crude oil prices, as we can see, are on the way up, and that might be a little bit of a risk. What I've tried to do over here is sort of create a comparison between the crude oil prices and Asian Paint stock price. And what you might see at times is like here you see, when crude really went up when Russia launched its invasion of Ukraine, and we had oil, gas, everything going up, and we saw this sort of a correction right there in the Asian Paints stock price, right? So there is definitely going to be some correlation between crude oil prices and Asian Paint stock prices. And as we see crude slowly inching up again, and with Ukraine targeting Russia's refinery infrastructure. There might be some pain within the entire industry, though. So that pain is going to be in the entire industry. So, but if that pain grows, if crude crosses $100 a barrel, it's 100% going to be a dampener on the stock. It's going to be a dampener on the margins that Asian Paints is going to be able to get. And because of that, we might miss out. I don't think that competition is going to be the reason Asian Paints as a stock doesn't do well. I think the only real risk is crude. If crude does cross $100 a barrel, then the stock may not perform this year. But as soon as crude starts stabilizing and going down again, Asian Paints would again be one of my favorite stocks. So that's my coverage, at least of Asian Paints. Let's now move on to stock number two. Stock number two for me is EPL Limited. EPL Limited is a stock that I bought practically at its all time high about 3-4 years back. I made a mistake with the entry into the stock. I bought it at the wrong time. I bought it at the top of its cycle. And I've learned about cycles because of this company. So I'm grateful to have that learning. It's come at a cost, but I'm grateful to have that learning. But having had that learning now, having had the patience to hold on to this stock through what's been a very, very difficult time over the last 2 to 3 years. And now I believe the stock is about to make a turnaround and go into a massive upcycle. And I feel now is when all that holding pain is going to work its way out, right? So let's talk a little bit first about EPL Limited. So EPL Limited is a global leader in extruded tube packaging, right? If you're buying a tube of toothpaste, there globally there's a 30 to 35% chance that it has been backed by EPL Limited. Absolutely massive market leader, global dominance, right? So we are going to go more into detail about its market leadership. We're going to go more into the details of why the underperformance had happened. We're going to talk now about what are the improvements that are happening and a potential upside over here with the TSA cost, which is the transaction service agreement cost. I'll talk more in detail. And importantly, here also, I want to talk about management commentary and targets. And, I'll speak a lot more about this in detail. But when it comes to my personal style of investing, this is probably one of the most important things that I look at. So let's talk a little bit first about EPL Limited, right? EPL Limited is an absolute market leader in its field. In the entire global market of these extruded tubes, right? It has a 20% market share in the world. In the world, it's an Indian company. It's a small cap. At if you're generous, you can call it a mid cap. It's less than 10,000 crores market cap value. The small, tiny company, 20% market share, boss, in the whole world. Whole world. Within the oral care, 35% in the whole world. 1 in 3 chance if you buy a toothpaste abroad or anywhere in the whole world, you buy a toothpaste, 1 in 3 chance it was backed by EPL Limited. Absolutely fantastic. It has been growing aggressively in the beauty, cosmetics, and pharma sector, where it now has a 10% market share, and I think it's going to aggressively look to keep growing in that sector. It's slowly building up its market share in the food, home, and industrial sector, and currently has an 8% market share. And I think in both of these segments also, it's just going to keep growing its market share, just because it's the one of the best companies at what it does in its industry. The industry went through a lot of pain recently. I think that's cleared out some of the competition. It has allowed EPL to grow market share, and that's going to really kick in the coming financial year. So let's talk about the underperformance of EPL over the past 3 years, and we'll go more into the industry headwinds. So I started buying EPL literally here. Literally here, I started buying EPL at around this 250 price mark, all the way up to its all time high of 270, 280. I was still buying EPL, and the mistake I made at that point is that the fundamentals of the industry and of the company started going down. And I kept buying more here, buying more here, buying more here, thinking that, it's all very, very temporary, there won't be any issues. And the stock went all the way down here. And that's when I realized I'd made a mistake, that what I thought would be 1 to 2 quarters of pain became 1 year of pain, and then 18 months of pain, and then practically 2 years of pain, right? And that has reflected in this long period of the stock price just not doing anything and of being very, very low, right? Almost a 50% sort of a, drop from its highs to its lows. And I've been there through that entire journey, very, very painful journey. But as you would have seen, it's recovering a little bit now. And what's causing this recovery is an improvement in the underlying fundamentals, right? Which we'll talk about further. So I just want to talk a little bit more now about the headwinds that had happened and where we can see it in the numbers, right? So, as you can see, 2020 was a good year for the company. So was 2021. You know, good growth in revenue, good growth here, fantastic margins. And then for the next 2 years, it's been a struggle for this company. Margins have gone down drastically, 17 to 16%, and that's taken a hit on the APS of the company. Um, Other issues have happened. You've seen a little bit of debt growing, so your interest has gone up. There's been some capex, which is called depreciation, to go up. So all of that, all of this pain has been going on in this company, right? So much pain has been there. But now the recovery is happening. The recovery is happening. I believe at least the recovery is really happening. And this is what had caused the pain, right? You see over here just how high the raw material costs had gone. So starting from Q4 of 2021, you start seeing this uptick. And that's where the pain starts in the stock price also. And the raw material prices over here practically doubled from Q4 2021 to Q1 FY23. So, in about the space of a year, raw material prices across the board practically doubled. And naturally, they tried to pass on some of those costs, but you can't pass on the entire cost, right? And that killed the margins of the company. It really created a lot of pain for the company. But now that the correction in raw material prices is happening, now that inflation is stabilizing and normalizing, now we're seeing the recovery that I feel is going to happen in the fund. The recovery is already happening in the fundamentals. It's not yet fully translated into the stock price, and that's where the opportunity is. And I think within this financial year, especially, we should see a big recovery in stock price. Now we look at the quarter on quarter financials just so that I can describe how the improvement has been happening, right? So, this is around where my entry into the stock price had probably happened. And you can see just how strong the financials of the company were. This was probably peak financials. You can just see how we went from 2.25 earnings per share all the way down to 1.06. This was the bottom for this company right here. Margins had collapsed. Depreciation was high. Interest was creeping up. Everything wrong that could possibly happen was happening for this company right here. But now, if you see the trend, it's slowly but surely improving. They had a fantastic quarter here, 2.65%, but that had a little bit to do with the tax. But in terms of just raw performance, finally, December 2023, last quarter results, big improvement. If you see the profit before tax, since December 2020, they were unable to reach this, right? And this lag, if you actually see the operating profit, it's actually improved from 158, it's gone to 183, right? So over here somewhere, so EBITDAs have improved, but over here somewhere, it's holding back the profit before tax, right? And we can see interest has gone up drastically and depreciation has gone up. So depreciation has gone up because of capex that has happened. So that has caused depreciation to go up, but that eventually, so they're invested in a new facility in Brazil, and as that facility comes fully online, we'll see this going up, and the percentage effect of this starting to reduce. They've also, and also obviously interest rates have gone up. To do this capex, they have to borrow more money, which is why the interest costs of the company have gone up. But this, I feel, over the coming 2 to 3 years, they're going to be able to lower. As Anand Kripalu starts doing his magic, I think we'll see this start to come down, right? But in general, this is the positivity. This is the positivity. Finally, the company is coming to life, right? Financials are improving. I think they're going to continue now to improve. There are no very obvious headwinds in the coming 1, 2, 3, 4 quarters. I think that should be expected as long as there's no other black swan events that affect this company. I think it'll just keep improving its financials now gradually. And with that, hopefully, the stock price should also follow. Another potential upside is that, so Blackstone had acquired EPL from the previous promoters, which was basically the Z family, the Z TV family, SL Propac, SL World. So they used to own this company. They sold it to Blackstone a few years ago. As part of that agreement, Blackstone has continued to pay out money to the Z family. That is now going to stop, right? I think FY24 was the last. I think from FY25 onwards, there's no longer going to be any TSA expenses. And this could provide anywhere between a 5 to 8% sort of a jump in PAT. So about a 15 to 20 crore sort of an improvement in PAT should be expected just because of this. And that combined with the improving fundamentals of the company, could see us achieving things like 30% type of PAT growth in the coming year. And when you have that kind of PAT growth in a company, stock price tends to outperform. Another very, very important thing to talk about is that about 5, 6 months ago, the management did a investor like a seminar, right, with institutional investors. So we, as retail investors, were not invited to the seminar. We could not attend it, but we can later, when they upload it, we can see the presentation that was shared. And this was the presentation that was shared with those institutional investors, right? And it's very, very important because for the first time in a long time, the EPL management has come out with a guidance with commentary. And the commentary for me is good, very good commentary. If this company can achieve these targets, even at the midpoint of its targets, I'm not even talking about the high point, even if it achieves the low to mid, there's going to be fantastic growth in the earnings. And we're going to see that next now and then. So this is my calculation and projection based on the management commentary. And you can just see the type of year on year growth, right? So FY24, we've already seen it achieve this fantastic PAT growth from a horrible base. We've already seen an improvement. I think that's going to now continue, and it's going to grow at a CAGR of just under 20%, 19%, right? This is a stock, current PE, right? Your current PE is around 20, and you're talking about a 20% CAGR growth in EPS, in earnings. Wow. Fantastic valuation for any company that might grow at this rate. It's a market leading company, fantastic management in Anand Kripalu, who's the current managing director. He used to be in United Spirits. He was behind the turnaround of United Spirits when it had been purchased by Diageo from Vijay Mallya. He's now, having overseen this very, very difficult time in the company, now he's going to oversee the next phase. Very, very positive on this. I think it's finally going to be a turnaround here. I really hope so. It's a big investment. It's a big portion of my portfolio personally. So I really needed to turn around and I hope it will. Right? So this was EPL Limited. Now my third pick is GMM Fodler, another small mid cap company. At one point in time, one of the absolute darlings of the market. But over the last 3 years, it's been the opposite of the darling of the market. I have recently entered GMM Fodler. I was waiting for the financials of the company to become, to get to the stage where it was a right entry for me. So I've been entering it at around 1500. It's corrected even beyond that, and I've been buying more. I've been accumulating more. Multiple reasons for me to like this stock. Um, you can see the bullet points over here, but let's skip ahead. Let's go straight into the actual details of this. The only one bullet point that I would like to mention, which I won't be talking about later, is the fact that the promoter has recently acquired shares at 1700 rupees, right? So the promoter is adding to the stock, and it's adding to a stock that is significantly above the current market price, right? Your current market price is 1300. Promoter has bought shares at 1700. Now, nobody knows more about the company. Nobody knows better about the opportunities and um, the growth of the company than the promoter. And if the promoter feels that yes, at 1700 it's okay to buy, trust me, boss, you can probably take a risk and buy at 1300. So I won't be talking more about this, but in general, this is another mental model to keep in mind. When promoters are buying or when promoters are selling, pay attention. Try to understand what is happening in the background. Try to break through, the regular sort of information that is provided to you and try to understand what's going on in his mind. What is he seeing that I may not be necessarily privy to see? And you might find hints of things happening, right? So I think this is very optimistic over there. Okay, but now let's go into it more. So GMM Fodler is also an absolute market leader in what it does. And this also is a mental model which I think is just important for people to. I mean, all the three companies that I've spoken about so far today are all market leaders in their respective fields. Asian Paints, EPL Limited, and now GMM Fodler. To be the market leader in an industry, you have to be the best, right? To be in the top one, two, three, depending on the kind of competition that there is in these industries. GMM Fodler is India leader by let's go back, right? So they have a 50% domestic market share, 20% global market share, 50%. And let me just show you an example. This is slightly older figures, FY19, but trust me, this has continued till date, right? The importance of being a leader and what it means. GMM Fodler has 50% of revenue. Look at its EBITDA share. 80%. 80% of the EBITDA, despite having only 50% market share. Why is that? Because it's better. It's just better than the competition. It has a bigger moat than the competition. Market leaders have bigger moats. They have better protections. They have better brand value. They have those invisible assets, those intangible assets that we cannot see on the balance sheet easily, that allow them to charge their customers that extra 2-3% more, that allow them to get that extra 2-3% cost saving from their vendors. That's the advantage of a market leader. If I'm in business today and I get somebody from a Tata approaching me, a Tata Group company saying, we want to sign a contract with you, I'm going to give them the benefit. I'm not going to sit there thinking I'll charge Tata 1% less. I'll give Tata the advantage of a 30-day payment period longer than I will to any other customer, because they have that trust, they have that advantage. That's the advantage of the market leader, and that's what you see here with market leaders. That's what you see here with GMM Fodler. They're growing faster than everybody else. 50% revenue share, 80% EBITDA share, highest ROCE of competitors. They acquired this competitor, D Trick, acquired by GMM in 2020. So, you know, appreciate market leading companies, because there's something special that has allowed them to become market leaders and something special that allows them to remain market leaders. These are strong companies with strong management teams. Never underestimate the market leader. That doesn't mean that you won't see that sometimes it's not better to bet on the competitor. Sometimes player number two might just be the better bet. An example of that I'll give you is of Borosil Limited, right? Borosil Limited entered into the opalware industry, where there was one massive market leader called La Opala, dominant market leader, and just see how Borosil Limited has captured market share there. So it can happen. A market leader can should not become complacent, but in certain the examples that I have taken, I believe are of all market leading companies that have held on to their shares, their industry share, and have grown their revenue shares and EBITDA shares over time, right? So currently for me, GMM Fodler is at a very attractive valuation. Again, we're going to be looking at the historic valuations which have been close to 60. That was partially because during COVID, obviously valuations were pushed high as earnings were pushed low. It was 100, ridiculous valuations of the stock, honestly. Now valuations are at around 30 PE. 30 PE for a stock like GMM Fodler, specialized industry, very specialized business industry, market leader stock, global market leader stock. This is cheap. This is very cheap. For a company like GMM Fodler, very cheap. And it's very interesting the poor performance of the stock, given the fact that earnings have not suffered. Earnings have continued to grow for GMM Fodler. It's not that this company, yes, there have been some industry headwinds, definitely, and margins have taken a hit because of that. But even then, GMM has managed to grow its earnings year on year, quarter on quarter. It keeps growing. And this is not small growth, boss. This is big growth, major growth. I feel market is underestimating the stock here. Yes, there was an incident when GMM Fodler sold shares to QIPs, to qualified institutional, it did a qualified institutional placement of shares to institutional investors, and it sold it at about a 35% discount to the market price. This was around here, and that's what caused the drop in market price back then, and the stock still hasn't recovered since then, but it needs to eventually recover, and I think it's now going to, and I'm hoping at least that now in this year we'll see that recovery. GMM Fodler, how it has grown, keeps growing, is through acquisitions, what it calls as bolt-on acquisitions, right? That means acquisitions that they're not going out there buying restaurants, they're not buying, they're not making ridiculous acquisitions. They're making acquisitions that are parallel to the current product portfolio, that are complementary products, right? GMM Fodler. So Fodler Group in India earlier was a subsidiary of GMM International, right? It was owned by the Patel family in India separately. In in 2020, 2021, the Indian subsidiary bought the parent company. That's why they had to do that QIP to get the funds to buy the parent company. That's the ambition of the Indian family group. The promoter currently, Mr. Tariq Patel, see his interviews, pay attention to his management commentary. Fantastically clear, intelligent man. Recently has bought shares at 1700 rupees a share, what we had earlier discussed. He has a vision, he has an ambition. Special promoter, very, very special promoter. You're seeing them constantly make acquisitions year after year, within a year, two, three acquisitions, really setting them up for the next leg of growth. What they're trying to do now is basically diversify the business and grow the non-glass lined business, right? So the main industry where they have that dominant market share is in the glass line business, um, where they make these uh, these sort of reactors, for the chemical industry and the pharma industry, and they make the linings for these reactors, right? The glass linings, to prevent corrosion, basically. Like I said, market leaders in that, but they've been adding other complementary technologies to diversify the business from the volatility that can happen within the glassline industry, right? So the glassline industry is heavily dependent on the chemical and pharmaceutical industry and the capex cycles of those industries. So both the chemical and the pharmaceutical industry very capex heavy, and so that's why they depend on these capex cycles. And in turn, as a proxy to that industry, GMM Fodler also has the highs and the lows of that industry, right? But the promoters have identified this. They've identified this as an issue and they're trying to mitigate that. And they've mitigated that by making these acquisitions in complementary sectors that allow the revenue share of the glassline business to reduce. So in FY21, 45% of revenues was coming from the glassline business. Today in FY24, that has come down to 32%. And non-glassline technologies have grown from 12 to 29%. Now you might notice that this doesn't add up to anywhere near 100%, but that's because GMM Fodler has services and it has AMC repair contracts also, right? So this makes up roughly 40% of its revenue also, right? So services businesses along they do basically turnkey sort of things, right? They don't only install the reactors for the chemical companies, they almost run the reactors in the beginning at least. And obviously it has AMC and repair contracts, and this is also a slowly growing important part of the business, and these are high margin businesses. Services is also doing very well, by the way, right? But the let's get back to this. The important thing that we're talking about here is the growth of these non-glass line technologies. They've grown to 30%, right? And it's almost now growing to the size of the glass line business. So this distribution, so if you actually see the revenue distribution of GMM Fodler, you have about 60% that comes from technologies and about 40% that comes from this services and AMC. This 60% is now going to become 30% glass, 30% non-glass. This is a key trigger for GMM Fodler. Okay. And the reason is, as explained here, 84% of revenue was coming from chemicals and pharma in FY21. Now it's 60%. So they can diversify away from the chemical and pharma industry and cater to a wider range of industry segments, including things like petrochemicals, the more other adjacencies of pharma, agro, it's different things that they're moving into now. And that diversification is allowing them to mitigate a lot of the volatility that is underlying in the chemical and pharma industry, right? And I think one of the reasons the stock price hasn't done that well over the last 1 to 2 years is because the chemical and pharma industry hasn't done that well over the last 1 to 2 years, right? And I think that's having a knock on effect on GMM Pfaudler. Okay, let's continue here. The company had come out with an guidance for FY25, and if you see the revenue targets, they've practically already met this in FY24, but EBITDA is proving to be a problem because of margins, right? But, and we'll discuss this in the next projections. I think they're going to achieve this EBITDA target by absolutely demolishing the revenue target. And important thing also to just keep a note of is this ROCE target, return on capital employed. It's if you can get a good growing company with over a 20% ROCE, you have something special. And I think this is important because it shows that the management understands this, right? The management is not only focused on revenue growth or profit growth at any cost, right? Because that can be a worry. That means the management is saying that, okay, we will achieve 20% revenue growth at any cost. We don't care. We want to grow revenue. So they would be willing to deploy capital even if it may not be EBITDA accretive, right? It may not be margin beneficial. But no, your GMM Fodler promoter understands the importance of things like Rossi. They understand the importance of efficiently allocating capital, of making sure that the acquisitions that they're making are going to add to the business and not take away from the business, right? And this is now my projection, right? So already in FY24, they've I think they're going to almost achieve that 3,700 crore target, right? And you can see from the previous base of FY23, we're already seeing a sort of 26% growth. In FY25, if they achieve their EBITDA guidance of 630 crores, I think we could see close to a 40% growth from FY24 of earnings, right? I think at the moment I'm showing a slowdown in FY26. I don't know if that's going to happen or not. I'm being conservative there. But even being this conservative, I think we can see a 25 to 26% CAGR growth in earnings. For a stock currently trading at 30 PE, there's comfort. There's comfort here. I'm comfortable, right? So that's my take on GMM Fodler, Asian Paints, EPL Limited. Three market leaders, three very, very different companies. But all the three companies, I feel, are available at attractive valuations. All the three companies have not been part of the recent run up over the past 1 year. I I think that looking at valuations is going to be even more important in the coming financial year. In the last financial year, nobody cared about valuations. Only thing people cared about was growth. If you were showing any sort of earnings growth, which a few companies were showing, there was massive rewards in terms of pricing. I think the coming year, after the mid cap segment has run up by 60-70%, I think the coming year people are going to be a lot more focused on valuations. And these are the cycles that always play out. People always say valuation is dead, but then valuation comes back to life, right? Valuations are never dead. It's integral to investing and it will never die, right? And so what we're seeing here, what I'm focusing on, at least for the coming year, is market leading companies, fantastic companies that have not been part of the run up in the last 1 year for whatever reason, whatever headwinds they might have faced, or whatever competition is entering, whatever, industries might be slowing down. So for that reason, the market has not, grown their pricing over the last 1 year. But I feel now that valuations are looking attractive in these particular industries, that the coming year might bring a bit of a bonanza in these stocks at least, right? So, as always, we're going to end with a quote. This quote is from Benjamin Franklin, one of the founding fathers of the United States. Fantastic inventor, writer, politician, philosopher, did everything. And his importance was to knowledge. An investment in knowledge pays the best interest. Everything in life is about compounding. And the one thing that you can compound that is going to help you the most in life is your knowledge. Spend time reading, spend time learning. The dividends you will receive from that will be greater than the dividends you'll receive from anything else in life. So stay patient, stay invested. Um, we'll be coming back in the middle of the week with another episode to cover another two stocks for my remaining, top five picks. Thank you all for joining in and wish you all the best.